So if you're in business with a partner, there's this hidden risk that can be way more damaging than any market crush. And it's not what you think. It's not about big blow-up arguments. It's about clarity. In this explainer, we're going to break down something called the Shareholder Blueprint, a framework designed to protect your business, your investment, and maybe most important of all, your relationships. And this quote just hits the nail on the head, right? The real danger isn't the loud disagreement. It's the quiet, untested assumptions that you and your partners are carrying around. Assumptions about your roles, about the money, and about what success even means. These are the little hairline cracks that form long before the whole thing comes crashing down. So how do these cracks even start to form? Well, it all begins in those exciting early days, when the thrill of just getting something off the ground kind of papers over some really fundamental misalignments. When you first start out, it's all about high trust and just trying to survive. You're a team, you're making it work with handshakes and this shared unspoken goal. But as the business grows, the stakes get a whole lot higher. Suddenly, decisions about money, strategy, and who to hire have real weight. And that's exactly when that initial, assumed alignment starts to get tested and honestly, often breaks, leading to all this tension and lost value. But here's the good news. You don't have to just sit around and wait for those cracks to show up. You can be proactive. And that's where this blueprint for protection comes in. It's a system that takes you way beyond just handshakes and hope. So what is this shareholder blueprint? Look, don't think of it as some stuffy, rigid set of corporate rules. It's much simpler than that. It's really just a framework for having the right conversations. It's a tool built for practical ownership protection, helping you get super clear on ownership, governance, and risk before they turn into huge problems.
Okay, so the blueprint is built on a few core pillars. We're going to start with the absolute foundations, the things every strong partnership has to have in place: people, rules, and money.
First up, people. In a business run by its owners, partners are almost always wearing multiple hats, right? So in any given meeting, are you speaking as a shareholder who owns the place, as a director who guides strategy, or as an employee who's running the day-to-day? Just getting clear on which hat you're wearing is such a simple but powerful concept for making better decisions. And this distinction, wow, this is where so much tension comes from. A salary is what you get paid for the job you do. A dividend is the return you get for the ownership you have. Mixing those two up, like expecting a bigger paycheck just because you own a bigger slice of the pie, that is a classic textbook recipe for friction. Next is pillar 2, rules. You know what kills speed and creates conflict in a business? Ambiguity. When it's not clear who gets to decide what, everything grinds to a halt. That's why defining those decision rights up front is so important. And this is pretty much how it breaks down. You've got the shareholders who approve the really big picture stuff. Then the board of directors guides the strategy and keeps an eye on how things are going. And finally, management is in the trenches, handling the day-to-day. When these lanes are crystal clear, you avoid all that gridlock and second guessing.
And that, of course, brings us to the big one: money. Specifically, the question that every successful business is going to face eventually: how much of the profit should we actually pay out to ourselves, the owners? And this isn't just a simple reward. It's a really important strategic decision. The answer to that question is what's called your dividend policy. Think of it as an agreement that just sets clear expectations for everyone. It makes sure that any decision to pay out profits is balanced against what the business actually needs, like, cash for growth or building up a rainy day fund.
So where do you even start with that conversation? Well, a common benchmark to get you going is to distribute around 50% of the after-tax profits. Now, this is not a hard and fast rule at all, but it's a really solid middle-of-the-road starting point for the discussion.
And this is absolutely crucial. Before any dividend gets paid, the business needs a serious health check. Can we truly afford this? You have to look at your cash flow, any debt agreements you have, your working capital, your plans for growth, and any big risks you see on the horizon. Because remember, profit on a spreadsheet doesn't always equal actual cash in the bank.
Okay, so you've got the foundation sorted out. People, rules, money. Now let's shift our focus to planning for the unexpected. Let's talk about the pillars of risk and the future. And look, this isn't just about protecting the business's bottom line. This is about protecting the partners as human beings. The vast majority of shareholder disputes explode during really stressful life events: an illness, a death, a divorce. Planning for these awful scenarios is actually one of the kindest and most respectful things you can do for each other. One of the most powerful tools for this is something called buyout insurance. I mean, just imagine a partner passes away out of the blue. Without a plan, their shares might go to a spouse who knows nothing about the business, and now the company has to somehow find a huge pile of cash to buy them out. This insurance provides the funds. It gives the family liquidity and certainty, and it protects the business from a full-blown crisis at the worst possible time.
And what about when it's time to sell the whole business? Well, these two clauses, they sound a bit like legal jargon, but they're essential for a clean exit. Tag-along rights basically protect the smaller owners from being left behind in a sale, and drag-along rights protect the majority by making sure they can actually deliver a 100% sale to a buyer, which is usually what a buyer wants. Together, they prevent a ton of potential conflict and protect the value for everyone involved.
So that's the blueprint. It's a really powerful framework. But you might be thinking, okay, but how do we even start? Well, the source material gives us a simple but really effective 15-question health check to get that conversation going.
So I want you to take a second and just ask yourself this, honestly. Right now, how healthy is the alignment in your shareholder group? Let's walk through a few key questions from that assessment to help you figure it out.
First up, alignment. Do you and your partners truly, genuinely agree on what success looks like? Is it all about revenue growth? Is it about creating a nice lifestyle income? Or is it about building an asset to sell in 5 years? If you all have different answers, that's a conversation you need to have like yesterday. Next, structure. It's one thing to talk about who does what, but are those roles and decision rights actually defined and written down somewhere? If the answer is no, then you're basically relying on memory and goodwill. And trust me, that is a very risky strategy as you get bigger. And finally, the exit. This can feel like a really tough conversation. I get it. But have you discussed it? Because every single partnership ends eventually. Talking about the end goal openly, while your relationships are strong, is the absolute key to having a successful journey together. These questions aren't about finding fault. They're about building a stronger future.
And all of this brings us to this final crucial point. Fair does not always mean equal. Let's say one partner puts in all the starting cash and the other puts in all the sweat equity. A 50-50 split might not actually be fair to either of them. The ultimate form of fairness in a business partnership isn't perfect equality. It's getting things agreed upon and written down early on. That is what protects everything you're all working so incredibly hard to build.